So let's bring in our guest this morning. We have Stephen King, who's HSBC's Chief Global Economist. He's also the author of Losing Control, The Emerging Threats to Western Prosperity. Isn't this a perfect timing for what we're going to talk about today?
Well, it's quite a horror story, yes.
Yes, it is.
Yes.
Let's talk about the expected market sell-off that we're expecting here across the Asia-Pac. I mean, you saw U.S. markets drop substantially because of the disappointing U.S. non-farm payrolls. I mean, what sort of sentiment are you gauging right now with, it seems investors are so jittery?
Well, I think what happened was that last year people were very, very optimistic that perhaps the economy had turned the corner, that policies were working, stimulating demand around the world. They suddenly discovered that, particularly in the States and also in Europe, there's just too much debt. The debt was redistributed away from the banks and from households towards governments, but the governments now are struggling to cope themselves with these huge amounts of debt. As a consequence, there's no more stimulus around, and with no more stimulus, there's many more doubts about the pace of recovery. That's
right. In fact, we had Tim Geithner over in Busan, South Korea, the G20 finance ministers meeting, saying you can't count on the U.S. consumer. Of course you can't count on the U.S. consumer. They can't find jobs these days.
Absolutely right. I mean, the payrolls numbers last Friday were very disappointing. Private jobs growth is very, very weak at this stage. And the key reason for that is that, again, there's too much debt. That in the States and in Europe, people have borrowed too much. And we're going to have to go through a hangover period now for the next few years where we have continuous austerity and fairly miserable growth, unfortunately.
Okay, so what does that mean for the currency markets? Because you call the euro part of the ugly sisters, which includes the dollar and the pound. I mean, where do you seek safety? What do you do?
Well, at the moment, of course, investors are looking at things like gold, which is, in one sense, obviously safe in current circumstances. But I think also it's fair to say that if you're having to choose between the dollar and the euro and sterling at the moment, then clearly the dollar is favourable, just from the point of view that people are incredibly uncertain about the politics of what's going on within the eurozone. But hopefully that will improve over the course of the next few months. Also worth noting, of course, that in the US, people begin to ask the first key questions about whether the US recovery itself is sustainable, and that will not help the dollar quite so much later in the year.
Okay, what about the euro? Make a call on the euro, Stephen. I mean, some people are saying maybe par with the US dollar by sometime next year. Do you think that's...
I think there's a lot of bad news in the euro already. And I think the key question now is, can the European leaders sort out their problems within the eurozone? Can they deal with all these questions about whether Greece will go bust or whether there'll be defaults elsewhere? If they can resolve that and come up with a political solution, then actually the euro is more likely to recover over the course of the next 12 months. But don't count on it for the next few days.
Right, and you said members of the euro would seek to leave the common currency. They probably won't because it's so politically embarrassing to do that.
I think one thing to remember as far as the eurozone is concerned is first and foremost a political rather than an economic event, and the political commitment is incredibly strong. I think investors both in Asia and in the States often forget that it's politics first and economic second.
Okay, well, let's talk about politics, because that was in play at the G20 finance ministers meeting, and a lot of people were disappointed that nothing really came out of this. I mean, they were expecting something to be said on Basel III with capital requirements being raised for banks, you know, liquidity and leverage was supposed to be discussed, but because of the European debt crisis, that seemed to be pushed aside.
Well, I think part of the problem here is that the G20 was put together during a moment of true global crisis a year and a half ago, and became quite successful for a period of time. Now we're beginning to see the differences of view that are coming through across different members of the G20. So the US wants to see a demand stimulus in other parts of the world, but the question is, well, where? Where does the demand stimulus come from? Not from China, because China's been growing too quickly already, trying to slow its economy down. As far as Europe is concerned, well, the big problem there in Europe is these very, very large budget deficits.
Absolutely. They have large deficits, and that's one reason why they didn't talk about these bank taxes, you know, having banks pay for these possible future bailout packages once again.
Well, one of the problems there is the lack of credit growth. If you look at money supply growth, either in the States or in Europe, it's extremely weak at this particular point in time. The danger with hitting banks particularly hard at this stage is it actually derails the recovery because the credit expansion that you want to see doesn't actually materialize. So the policymakers are very cautious about that.
Yeah, Stephen, I'm trying to squeeze this in 30 seconds here, but what about the European debt crisis? Is this the worst of it, or is it going to get even worse from here, uglier?
It's going to get tough over the course of the next 2 or 3 years. These deficits and debts are very, very high indeed. Lots of tax increases, lots of spending cuts, lots of protests. It can be really difficult.
Okay, Steve. Well, thanks for dropping by. Nice seeing you.
Pleasure.
Stephen King there, HSBC's group chief economist, also the author of Losing Control, which seems to be good timing these days to read up on.